Welcome once again to Casting Strategies. Today I have the immense honor of interviewing Kai Wu. Now I'm switching to English because I'd like him to understand me. As you know, afterwards we'll have the interview interpreted into Spanish so that you can all understand the interview. So I'm switching back to English and we'll continue with the interview now.
So today we are going to interview Kai Wu. Kai Wu is the founder and chief investor officer of Sparkline Capital, an investment management firm applying state-of-the-art machine learning and computing to uncover alpha in large and structured data sets. Prior to Sparkline, Kai co-founded and co-managed Kaleidoscope Capital, a quantitative hedge fund in Boston. With one other partner, he grew Kaleidoscope to 350 million in assets from institutional investors. Kai jointly managed all aspects of the company, including technology, investments, operations, trading, investor relations, and recruiting. Previously, Kai worked at GMO, where he was a member of Jeremy Gratham's 40 billion asset allocation team. He also worked closely with the firm's equity and macro investment teams in Boston, San Francisco, London, and Sydney. So, hello, Kai. How is everything over there?
Hi. Thanks for having me on. Yes, things are great. Things are awesome.
Awesome. So, I'm super excited. So, I'm going to just go straight for the first question. And my first question is, what drove you towards the investment industry in the first place?
I think it's mainly just my intellectual curiosity. I'm fascinated with trying to uncover the mysteries of the universe. Why is it that businesses succeed and fail? Why is it that interest rates rise and fall? Governments, things like that. And, markets are just so interesting because they're a kind of reflection of so many forces in the world, right? So technology, globalization, politics, psychology, quant, all these different things are reflected in markets. And, as opposed to saying going into a more academic field where you don't get the feedback on a day-to-day basis of are your hypotheses correct or incorrect, the beautiful thing about markets is you will get the ability to iterate and kind of refine your theses over time.
Totally. That's super interesting. And actually, what you're saying is interesting because this idea of uncover the mysteries is something really cool. But regarding the finance industry, it's true that also the data, it's in general, is pretty unstructured data. So, and this is complicated also for this kind of machine learning. Machine learning can work with unstructured data, but also we know that if the data is structured and it happens to be much better. So how do you cope with this situation when applying machine learning and in this space, this financial space?
Yeah, it's funny because a lot of people use machine learning and AI because they think it's cool. And they take the data that they have been looking at for decades and say, well, it worked pretty well with the regression. Let me use like a neural net, right? So my approach towards using AI and machine learning is actually kind of starting with the question first, right? So what is the question what is the problem I'm trying to solve? And you mentioned it yourself, unstructured data is a really, really important part of the puzzle that currently is missing from most quant investment strategies. So if you think about the world, right, there's kind of two camps. There's quants and discretionary investors. So quants have the advantage of computing power, scale, algorithms, and processing power, but they tend to focus on a very limited subset of information, which is structured data. So, price, volume, CompuStat, so information, in the financial filings like P ratios, price to book. Discretionary investors have theoretically the ability to look at everything, right? They can get on the calls with management. They can read through the MD&A section of all the filings. They can set up RSS feeds to follow the companies in the news. The problem, of course, is for discretionary investors that they don't have the same processing power that we as quants possess. And with more data being created in the past 2 years as all of human history, with the amount of data growing exponentially, it becomes increasingly untenable to keep up with that pace without trying to leverage some modern techniques. So the reason I kind of decided to go down the path of exploring machine learning and utilizing it in my trading is, I see it as kind of the one solution that we have, right? It's almost like not that I think it's cool and I want to do it. It's not really an option. It's kind of necessary. It's the only way for us as investors to bridge these two things, because both schools will struggle otherwise, right? With more and more data being created, it's going to be challenging for a old school investor to succeed without leveraging modern tools. At the same time, quants, if they're just trying to use fancier techniques on the same old information, are not going to make progress. They're trying to squeeze the last bit of juice out of the lemon, so to speak. And what's been fortunate is there's been a lot of innovation, actually, mainly out of Silicon Valley, so not even in New York, where I am, around deep learning, natural language processing, and the ability to take large corpuses of unstructured data and process it in a structured way. And I think that within this tool set lies the key for allowing us to take this unstructured data, which, by the way, is 80% of data. 20% is structured currently, 80% is unstructured. And by the way, that rate is growing over time because data is being created faster than it can be structured. The only solution we really have is to look to what they've done, say, at Google and Facebook, with Google Search and Translate, and take some of those tools and use it to take this 80% of information and bring it into the investment process in a systematic, scalable way.
And that's clear, but with more businesses data being released for machine consumption, how will that impact unstructured data analysis? Because I think it's this idea of growing and growing and growing, it is being also much more complicated to cope with that. So how do you think this is going to impact in unstructured data analysis?
So when you say business data, you mean unstructured business data, or you mean structured business data?
Unstructured.
Yeah. Well, look, the ability for these algorithms to succeed depends on three factors. So first is how good are the algorithms themselves, right? There's been a couple interesting discoveries and inventions over the past few years, like transformers, for example, being an important innovation. The second thing is the data itself, right? You have a 300 million parameter model and like 5 pieces of data, you're not going to get very far. So more and more data is obviously good. And finally, computing power. You can have a 300 million parameter model and unlimited data, but if it's too expensive to train it, then it's not actually feasible in the real world. And obviously, Moore's law and the kind of decreasing cost of computing has been essential for making deep learning a feasible technique. But yeah, the second thing I said is, the amount of data is critical. If think 10, 20 years ago when there wasn't that much data available, these techniques, even if we did have the computing power and these things had been invented, they would be basically useless. Like, what would you run them on? But what I'm doing myself, and I think a lot of quants who are in my shoes are thinking is, look, we're going to skate to where the puck is going, not where it is now. Yes, unstructured data is 80% of data. Yes, data is pretty big, but all you have to do is fast forward 5, 10 years and where things are headed, right? There's just going to be more and more information. And right now it's a toss up. It's hard to say, oh, do quants have the edge? Do discretionary investors have the edge? But the point is that in 5 to 10 years with data, 10, 100x bigger, right? I mean, it's pretty clear that, who set up to succeed. So I think going to your question, yes, the explosion of data from unstructured data from businesses will, certainly tip things in favor of quants.
Actually, what I see in this situation where we stay currently is that the world is changing a lot. And I think the AI, machine learning, this idea that we are getting through now is, it's going to change the world. Do you think this, in the financial industry, we need to, in general, AI and machine learning will change the scope of this industry? Do you think this is gonna, we are gonna see a big change in the industry regarding that and using machine learning, AI, and all that stuff? Yeah,
I think that these techniques will be transformative. I think the timeline is probably a little slower than a lot of people who are close to the field expect, right? Things always are a little slower than things you might think. I think in particular, think about the classic idea of disruption, right? Where, new ideas come in at the bottom and then work their way up the value chain. I think that's what we'll see here, right? Like, I know I'm using AI in my trading, but I'm a very small percentage of assets, and I don't see myself becoming, Vanguard anytime soon. So I think more realistically, what happens is AI is used to pick the low-hanging fruit. So you think about like what are some like mundane, rote, automatable tasks that us as financial analysts spend a lot of our time doing that just really isn't worth our time. It's just like not high value stuff. So for example, like named entity recognition, the idea of reading through thousands of documents and finding those that say match specific companies. So you extract the tickers and the company names from different things and say, all right, well, that manually going through all those documents would be, a really foolish use of an analyst's time. Machines are very good at that. So that's step one, do that first. Why not? And, I think the way I see it is, the vast majority of assets are currently managed from using fundamental discretionary techniques. The way I see it is the first thing that happens is AI creates tools for the existing investor base to do their jobs more efficiently and better. And then over time, the tools get better and better and better as they're trained on more and more data, and the humans give them more feedback until at some point it tips and it's better than humans. And at that point, we might see some job changes. But I think that's a little ways off. And it's the same in any other industry, right? You think about what people are talking about with like radiology, right? They're reading like looking for cancer and things on slides, right? Computers are pretty good at it, not as good as like the best radiologists, but over time, it's a way of giving a single doctor the ability to, leverage their skills more broadly. But over time, it will almost certainly get better and better. And then once things tip, that's when things get interesting. So, that field's not there yet. And, obviously we are not either in investing.
No, totally. Okay, we are just trying to get it. So all of us. So it's cool. Okay, and talking about your trading, your trading is particularly. So where do you put your machine learning and AI into the pipeline process? Talk us a little bit about through that.
Yep. So I think there's 3 areas where I use machine learning in my investment process. So the first is in unstructured data. The second is what you call alpha combination, which is extracting signals from a matrix of data. And third is risk modeling. So on the first one, right, most quant processes have a bunch of data feeds coming in. It might be CompuStat, it might be Bloomberg, whatever, right? Most of the data is structured. For me, the way, based on what I just told you earlier, I think there's a huge opportunity in unstructured data. I think there's a lot of information there, and by the way, it's not well mined by quants. So there's a lot of kind of untapped value there. And so if my thesis is correct, then we want to go after that. So the first area where I'm using machine learning is to take all this information in and process it, right? So the problem with unstructured data, in particular text, is that it's super high dimensional, right? You have even just a single 10K filing has a vocabulary of tens of thousands of different words, right? Just a very sparse matrix. You can run that through regression, you're not going to get much information. And that's where, a lot of the techniques that, I've talked about, BERT being a famous example of a model that came out of Google, is specifically designed to take these unstructured natural language processing, unstructured textual data and make sense of it. So these are the specialized NLP models, deep learning models. That's use case number 1, to take this information and bring it in as a feed alongside many other traditional things, such as Bloomberg and FactSet. So that's step 1. Step 2 is now that you have all the information, you have, let's say, thousands of different signals. Well, how do you actually combine them? Are you just going to take an equal average? Or are you going to manually say, well, I think value is a good thing, so I'm going to put a 1 on that, and I'll put like a -1 on this one, right? So choosing the sign as well. That's a pretty hard problem. People typically use regression to solve that, but again, as the dimensionality of the problem increases, it actually creates huge issues for things like regression, right? Because they implicitly rely on the inversion of a covariance matrix, which is going to be singular and have some problems as you get bigger and bigger. And so that's where new techniques come in. I've been using boosting, which is like a variant of random forest, as well as some shallow neural networks. And I found that it's nice because not only does it allow you to approach the data from an objective standpoint, right? You can remove the bias that you might have knowing that value investing tends to work, let's say, or quality investing tends to work and this other thing doesn't. So you can kind of remove the subjectivity. But the kind of value add of these methods over and above traditional linear regression is, aside from the scalability I already mentioned, the ability to deal with nonlinearities and interactions, right? So nonlinearities are pretty obvious. It's like, if a company has a little bit of leverage, it's not a big problem. But if it has a lot, that could be a problem. Or interactions being, look, momentum investing, so the idea of buying things that have been going up, has kind of lost a lot of its effectiveness as it's become so popular. But if you intersect that signal with something like news, it turns out that when some big event happens and then there's momentum out of that does continue to trend, those intersections might be valuable. So by adding nonlinearities and interactions into the process, you can go above and beyond what a traditional regression might do. And then for the third piece, it's on the risk modeling side. So if most equity traders are familiar with the idea of BARA. So BARA is just an idea of saying we can, as a risk model, we can decompose the returns of stocks, cross-sectional returns, into idiosyncratic components, but then also components driven by factors such as value and size, and then also industry components. So, tech stocks tend to be correlated with each other. Energy stocks tend to be correlated with each other. Now, the problem with their industry classification scheme is it's binary. And what that means is it's super rigid. Doesn't really capture all the kind of dimensionality in the business landscape. So for example, Tesla, right, which is going to join the S&P soon, is either an auto company or a tech company. It can't be both. And Amazon, right? Amazon started off as an e-commerce company and now is like half that and half AWS, half like a cloud computing company. That won't show up through time. Like the dynamism of their business and the kind of continuity of the fact that businesses can have multiple segments doesn't show up there. And so what I've done is I've used machine learning actually to create my own more continuous objective version of industry classifications. So what I do is I look through all the 10K filings, and the first thing each company does is it talks about what they do. And it turns out that the way companies describe themselves clusters in ways that are super intuitive. So you can say, let's look at all the companies, and those that talk about the FDIC, they're probably banks. And by the way, Tesla sits somewhere between the autos and the tech companies. And using that technique, what I've actually found is that it creates portfolios that are optimized. In other words, that strip out systemic risk and have higher risk-adjusted returns in a better way than traditional models like BARA do. So yeah, those are the three areas.
In the second one, I just you were talking about that, and one question came up, that is, it is helping you also to allocate different factors into the portfolio, right? I mean, it's not just this idea of being able to identify the factors and see if they are were the factors that you can apply at some point, and then model a portfolio, but using the allocation of different factors. Is this correct? This is what in a simple way to explain it for the audience.
It solves three problems. So first is feature selection, right? Which is the idea of what things go in your model and what things get thrown out. In other words, what's get weight of 0 versus non-zero. The second problem it solves is, what is a sign? Is it should you go long or short of the factor? And the third factor it solves is how much weight to put on. You can have two factors that you both want to go long on. One maybe matters a lot more than the other.
Totally. Okay, gotcha. And I have a last question, Kai, that is, this one has to do with one of your papers that is super cool, that is called Value is Short in Tech. So can you talk us through the main ideas behind this paper? Because I see that clear, but since this interview is going to be dubbed into Spanish, I'd like our audience to have your thoughts, the headlines of the paper, just now in a couple of minutes.
Sure. So yeah, my background is actually, I used to work for GMO, which is a well-known value investment shop. And so, one of the problems that us as value investors have, faced is just pretty much awful performance the past 10 years. Value, let's define it using price to book, like the way Fama and French might define it, has basically only lost money. And not only has it lost money for 10 years, but the last year has just been awful, right? I mean, in COVID, value has just got destroyed. And, intuitively, there could be lots of explanations for it. But one thing that people kind of intuitively know is, it must be because value is shorting all these tech stocks. So at least, I mean, value in the sense of long value, short growth as an overweight, underweight thing. But what's super interesting is, and actually Cliff Asness at AQR looked at this, which is when you adjust for sectors, it doesn't actually solve the problem. It maybe helps a little bit, but it turns out that even adjusting for tech, so in other words, only going long, short within tech, long, short within industrials, long, short within energy, doesn't actually solve the problem. Value has still done pretty badly. So that seems kind of weird, but when I actually look at the stocks, I was like, well, actually this kind of makes sense, right? You think about the FANG stocks, there's 5 of them. Only one of them is a tech stock. The others are communications or consumer discretionary. So clearly these industry classifications are missing the point. And this is kind of what I was saying earlier with the example of Tesla.
Exactly.
Yeah, exactly. These things are super arbitrary and they don't capture very much nuance. It turns out that it's not 2 tech companies can be totally different, but yet be in the same sector. And so what I'm about doing is defining what I call disruption, which I think gets at this idea of what's been ailing value investors in a more kind of true sense, which is to say, look, we all know it's the case that the blockbusters of the world have just been crushed, and anyone who thinks that they're cheap because they have low price to book compared to, say, trailing 12-month fundamentals are missing the point. They're just going to ride it all the way to the grave. And on the flip side, trends like the cloud, I mean, they're for real. They're here to stay. And is it just the case that value investors have latched onto that and are unfortunately being hit by that factor? And so in order to do that systematically, right, because that's a hunch I had, but in order to actually quantify it, I used my NLP and kind of define what I call disruption factor, which is companies that are either disruptors or disruptees or being disrupted. And when I took those 2 groups and I said I ran value long, short within each, the same way you might with sectors, with industries, but instead doing it along the dimension of disruption, I found that it fully explained the drawdown of value. So value is not going up, but at least it's not going down. And the point there is that it has been the case that value has maintained a pretty consistent short 20% or underweight 20% exposure to the disruption portfolio, which, by the way, has done phenomenally, right? That thing only goes up. These companies have done so well. And so even a small 20% weight against them has been crushing.
And what is the conclusion that you get from that? Should we invest? How?
So I think I think the conclusion is to, first of all, you just need to know what you're doing, right? Everyone should know what they're betting on. If you're making these backdoor bets, implicitly betting against disruption, but you think you're just buying value, you're kind of missing the point. So I think it's really important for investors, allocators, and stock pickers to just know what they're doing and to be able to make that call. Right? It might be the case that some of the sub themes within the disruption basket are bubbles, right? Because that's implicitly what value investors are saying. Maybe these EV SPACs are a bubble, but is cloud computing a bubble? I don't know, but let's separate it into this constituent parts, and then we can take targeted views along each dimension, as opposed to just saying, all right, I'm just going to programmatically buy cheap stocks on this one metric that, by the way, used to be really good back in the day of Ben Graham, but today has no actual accounting relevance. It doesn't seem like a good path forward.
Actually, in our next interview, we will be talking about the intangible assets that I think is a super interesting thing that we have to bring up. Thank you, Kai. It's been a pleasure. So I don't know. I think this is an interesting topic. I think we have to keep talking about these kind of things because the world is changing, and all of this. A lot of people is trying to make the case for value, and a lot of people is falling, in my opinion, into the confirmation bias, trying to look for, to understand that value is going to come, it's not going to come back, looking at the past, but actually the future is different and it's going to be different. And I think there are many things that we have to discuss about that in our next interview. Excellent, guys. Right. So thanks a lot. And thanks. It's a pleasure to have you on our show. I think our audience is going to enjoy a lot this interview, and I hope we keep in touch and we will be talking again in another moment. Thanks, Kai.
Thank you.
Today we had Kai with us. If you liked the interview, give it a like, subscribe to the channel, and share the interview. See you next time. Bye bye.